Hold on to your seats as we delve into the whirlwind of events that have recently swirled around PayPal, the global payment giant. Over the past few months, the company's stock has been on a roller coaster ride, triggered by a combination of factors. On the bright side, PayPal is expected to experience accelerated revenue growth and improved margins. This is largely due to the long-term growth trend of the e-commerce market, where PayPal operates as a global payment network with millions of active merchants and consumers. Yet, the journey hasn't been entirely smooth. The company has faced concerns over competition from alternative payment methods. But here's the kicker. PayPal's power users are unlikely to switch providers. And why would they? PayPal's core business has been growing faster than Apple Pay and Venmo, its main competitors. This growth, coupled with PayPal's high acceptance rate among retailers and a higher conversion rate, makes it a formidable force in the payment industry. But that's not the end of the story. So stay with us as we delve deeper into these events. Now let's dig into the strategic moves that PayPal has been making in the face of these challenges. PayPal has been proactive in implementing a cost reduction program, working diligently to streamline operations and boost efficiency. This initiative is not only about preserving the bottom line, but also about ensuring the company's ability to innovate and stay ahead of the curve in a rapidly evolving financial landscape. A key strength of PayPal is its solid balance sheet, underpinned by significant free cash flow. This gives the company the financial flexibility to invest in growth opportunities, weather economic downturns, and even return capital to shareholders when appropriate. Speaking of returning capital to shareholders, PayPal has a share buyback program in place. This is a strategic move that not only demonstrates confidence in the company's future prospects, but also helps to increase shareholder value. Share buybacks can reduce the number of shares in circulation, thus increasing earnings per share and potentially supporting the stock price. Interestingly, despite these strengths and strategic initiatives, PayPal's stock is currently trading below the average and median of its peer group. This could be seen as an indication that the market is undervaluing the company. However, there are also expectations of a potential re-rating of the stock. With the company's accelerated revenue growth, improved margins, and strategic initiatives, there's a growing belief that the market may be underestimating the turnaround in PayPal's fundamentals. These moves show a company that is not standing still, but is actively working to improve its position. PayPal is not just reacting to the challenges it faces, but rather it's strategically positioning itself for long-term success in an increasingly digital and cashless world. Meanwhile, in a move that has caught many by surprise, PayPal is exploring a potential merger with Pinterest. Yes, you heard that right. PayPal, the global payment giant, and Pinterest, the beloved social media platform, may join forces in a deal valued at a staggering $39 billion. This news has sent ripples through the market. Pinterest stock leaped by 19% as investors responded positively to the potential merger. However, the reaction for PayPal was a bit different. Their stock fell by 5%, suggesting some investors might be skeptical about the benefits of this proposed merger for the digital payments company. So why this surprising move? Well, PayPal has been on a strategic journey to expand and diversify its business. This merger could be a part of that plan. Pinterest, with its strong user base, particularly among home decorators and designers, could offer PayPal an avenue to tap into a new demographic. On the flip side, Pinterest has seen a slowdown in user growth as the economy reopens, and this merger could provide the social media platform with a much-needed boost. However, it's important to remember that these are early days. Negotiations are ongoing and the outcome is still uncertain. There are bound to be hurdles to cross and questions to answer. For instance, how will PayPal integrate Pinterest services into its own? And what does this mean for the competitive landscape of the digital payment industry? This potential merger shows how PayPal is looking to expand its reach and diversify its business. Only time will tell if this bold move pays off. Stay tuned as we continue to follow this exciting development in the tech and finance world. As we wrap up our deep dive into PayPal's recent events, let's summarize the key points. We've discussed how PayPal is expected to experience accelerated revenue growth and improved margins, which may lead to a potential re-rating of the stock. Despite the challenges of lower customer account growth and shifting profit margins, PayPal's core business has been growing faster than the likes of Apple Pay and Venmo. The company is implementing a cost reduction program and has a solid balance sheet with significant free cash flow, positioning it for future success. We also touched on the strategic moves PayPal is making to improve its position in the market. The company is not only a global payment network with millions of active merchants and consumers, but it's also looking into potential acquisitions to further boost its offerings. One of the potential mergers on the table is with Pinterest, a social media platform popular with home decorators and designers. This merger could potentially expand PayPal's reach and diversify its user base. With all these developments, PayPal is indeed a company to watch. Make sure you hit that subscribe button to stay updated on all things PayPal and more. Until next time.